Every month, Dividend Radar publishes a spreadsheet of dividend champions, contenders, and challengers. Challengers are companies that have raised their dividends for 5 to 9 consecutive years, contenders for 10 to 24 years, and champions for over 25 years. Dividend Radar is a great starting point to screen high-quality companies that have prioritized their dividends over many years. Today, we're going to take a deeper dive into real estate companies on this list and see how they compare. If you enjoy this content, make sure you hit the like button and subscribe to the channel for future videos, and make sure you turn on notifications to get notified every time we release a new video. REIT stands for Real Estate Investment Trust. REITs invest in real estate from hotels and casinos to multifamily apartments and farmland. REITs are attractive for dividend investors because they are legally required to pay out at least 90% of their net income to shareholders every year in cash dividends or equivalent stock credits. REITs provide exposure to the real estate market without the downsides of owning property yourself. To rank these stocks, I pulled 10-year historical data for each REIT challenger, contender, and champion. When comparing the stocks on this list, I had a few criteria to keep in mind: dividend yield, dividend growth, length of dividend increase, dividend growth rate of change, payout ratio, net income growth, free cash flow growth, operating income growth, and earnings growth. For details on how I score stocks for each category, check out my stock ranking deep dive video on my channel. Number 5 on the list with a score of 57.5 is National Storage Affiliates, ticker symbol NSA. NSA was founded in 2013 by merging 3 regional self-storage REITs, SecureCare, Northwest, and Optivest. National Storage owns, acquires, and manages self-storage facilities across 42 states and Puerto Rico, currently holding ownership interest in over 1,100 different facilities. NSA currently yields a 5.3% dividend and trades at $41.93 per share. The dividend has been increasing for 8 years with a growth rate of 15.9%. This growth rate should be expected to slow as the dividend growth rate of change has been declining at an 11.8% annualized rate. The aggregate payout ratio for NSA comes in very high at 504%, mostly due to low net income and earnings numbers between 2016 and 2020. The average payout ratio for free cash flow was only 53%, so this might not be anything to worry about, but keep an eye on the free cash flow payout ratio if you decide to buy this stock. National Storage has seen extremely strong growth in its financials, with net income increasing by 32.9%, free cash flow by 42.4%, operating income by 44.5%, cash flow by 40.3%, and earnings by 38.2% annually. This REIT offers a high dividend yield and strong dividend growth in a historically safe industry. Although the earnings and net income payout ratios are high, even by REIT standards, I don't believe the dividend is in jeopardy anytime soon due to the low free cash flow payout ratios. Number 4 on our list is Extra Space Storage, ticker symbol EXR, with a score of 58.63. Extra Space Storage is a company specializing in operating self-storage facilities and is the second largest such operator in the US. The company currently owns or operates over 2,000 locations with approximately 1.4 million storage units. Extra Space Storage currently yields a 4.1% dividend with a 10-year dividend growth rate of 14% and has been growing their dividend for 14 consecutive years. This growth rate is slowing, however, with the dividend growth rate of change decreasing at a 13.5% annualized rate. This declining growth is offset by stable payout ratios by REIT standards, averaging 84.6% across multiple income metrics. Payout ratio for net income has a high average of 106%, but that of operating cash flow and free cash flow comes in at a sustainable 69.7% and 69.8% respectively. Financially, Extra Space Storage has put up some impressive numbers over the past 10 years. Net income grew by 22.3%, free cash flow by 17.2%, operating income by 16.3%, cash flow by 17.1%, and earnings by 19% annually. Although this REIT offers a modest dividend yield and a slowing growth rate, the dividend seems fairly safe given the lower than average payout ratios and strong financial growth, making EXR an excellent choice for the conservative investor. Coming in at number 3 is Vici Properties, ticker symbol VICI, with a score of 61.25. Vici Properties owns and operates some of the most high-profile gaming, hospitality, and entertainment venues in the US, including Caesars Palace, MGM Grand, and the Venetian in Las Vegas. In total, Vici owns 49 gaming facilities, 59,300 hotel rooms, and 450 restaurants, bars, nightclubs, and sportsbooks. Vici's dividend yield is currently 4.9%, and has been increasing at an 8.1% rate since 2019 when they paid their first dividend. Their initial dividend growth was strong, but has since tapered off at a compound rate of 15.3% per year. The aggregate payout ratio for Vici is a modest 80.9%, fairly low for a REIT. Financially, Vici Properties has enjoyed double-digit growth across all measured income metrics. Net income has grown 37.8% annually, free cash flow by a whopping 60.6%, operating income by 34%, cash flow by 60.1%, and earnings by 15.5%. I'm personally surprised by how well Vici is able to balance such strong dividend growth with relatively low payout ratios. The stock is currently at near all-time highs, so now might not be the best time to buy, but you bet I'll be scooping up this REIT once the price dips a few percentage points. Number 2 is Arbor Realty Trust, ABR, with a score of 62.54. For almost 25 years, Arbor Realty has provided financing for commercial and multifamily real estate developers across the United States. Unlike the other REITs on our list, ABR doesn't actually own any real estate, but generates its revenue from interest charged on their various loan products. ABR currently offers a staggering 13.9% dividend yield with a 10-year growth rate of 15.1%. Arbor Realty has been raising their dividend for the past 11 years, making them a dividend contender. Like other high-yield dividend companies, their dividend growth rate is slowing at a rate of 15.1% per year. The aggregate payout ratio sits at 109%, mostly due to high ratios from free cash flow and operating cash flow. Although the EPS payout ratio is low, I am concerned with the high free cash flow payout ratio, so that is definitely something to keep an eye on in the future. ABR has seen strong growth in its financial metrics over the past 10 years, increasing net income by 43.1%, free cash flow by 17.6%, operating income by 26.9%, cash flow by 17.6%, and earnings by 9.2% annually. Arbor seems like a high-risk, high-reward play to me. The high yield is great, but the payout ratios are very concerning. Since ABR doesn't hold any physical assets and makes all their money through lending, higher interest rates could harm their business prospects in the future. Finally, at number 1 with a score of 67.22 out of 100 is First Industrial Realty, ticker symbol FR. First Industrial leases, manages, develops, buys, and sells commercial real estate properties, focusing on distribution centers and other logistics properties, and has been doing so for over 27 years. As of December 31st, 2022, First Industrial owns over 68.9 million square feet of industrial property and serves more than 1,000 tenants across much of the country. The dividend yield of First Industrial Realty is not very high, coming in at just over 2.5% with a growth rate of 12.4%, and has been raising their dividend for the past 11 years. This strong growth is slowing, however, with the dividend increase slowing at a rate of 20.4% per year. First Industrial Realty's payout ratios were very safe, with all ratios averaging below 72% for the past 10 years. Lastly, looking at First Industrial Realty's growth in its financial metrics, we find strong growth in net income at 28.7%, free cash flow at 12.1%, operating income at 9.1%, cash flow at 12.1%, and earnings at 25.4%. These data paint a picture of a company with a conservative stance on dividend payouts, but very strong growth in fundamentals. The low payout ratios and slowing dividend growth make me think that First Industrial Realty will continue to grow its dividend even in the face of economic hardship. If you're looking for a reliable dividend that is likely to continue to grow and remain safe from financial turbulence, and you're okay with lower yields, FR could be a good pick. Thanks for watching this video. If you found this information helpful, please give us a like and consider subscribing to the channel and leave a comment to let us know what you think. As always, stay safe and take it easy.